Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, the oil game uncovered. If there was any doubt about who's in charge, then it was rammed home this past week at the Doha Oil Summit. Hopes for a freeze in production played second fiddle to regional rivalries. While behind the scenes in Saudi Arabia, there's a new force emerging in crude oil power politics. Also this week, the smartphone and the undeniable truth that these devices are starting to run our lives. But are players getting shut out of the mobile revolution by big guns like Google? We look at the latest European Union antitrust charge, which questions the way software is pre-installed on some of our mobiles. And the hunt for better trade routes. China's now contemplating using a shortcut through the Arctic Circle, which has been otherwise impassable. Along with a new economic corridor through Pakistan, it's the Silk Road done 21st century style. As we often say, power lies with the few. But what do you do when just 20 people, 20 energy and oil ministers from around the world, attempt to use that power but can't come to a decision? That's what we found out this past week when OPEC and non-OPEC oil producers held an extraordinary oil summit here in Doha. With the price still low and the market heavily oversupplied, they were trying to find some consensus on a way forward. But they didn't, and there were repercussions. This week we'll take a global look at how the oil industry stands right now, from Oklahoma to Azerbaijan, but we'll start here in Doha with that very long meeting.
For 12 hours, they came and went. Energy ministers from the bulk of the world's oil-producing nations, back and forth along the corridors of a Doha hotel.
Excellency, have you reached a deal? Did you have a nice nap?
Saying either nothing or very little at all for 12 hours. What was hoped to be a comparatively short and sharp meeting, where an oil production freeze would be agreed for the good of the entire industry, instead turned into a metaphorical tug-of-war, an arm wrestle. Who could get what they wanted for their country's oil industry with the least amount of compromise? It was left to the Qatari energy minister to explain to the huge media gathering that there was essentially no deal.
The meeting concluded that we all need time for further consultation, and from now till June meeting in OPEC, all participating countries will consult among themselves.
In the end, Saudi Arabia wasn't going to agree to a freeze in production without the participation of Iran, meaning a deal was almost impossible from the outset. So with nothing changing in Doha, the next chance for just OPEC members to discuss output and production is only early June. That means for the next 6 weeks, the oversupply will continue to be supplied, up to 2 million extra barrels a day, and the oil price will unlikely recover.
So in those 12 hours, what did we learn? Well, maybe we didn't learn this, but it was certainly reinforced that Saudi Arabia is still the boss. If the game of oil is about survival of the fittest, then it's very well placed. But this oversupplied market has got the Saudi powers that be looking outside the box, or barrel as it were. And much will be, it seems, in the hands of this man, the Deputy Crown Prince Mohammed Bin Saleh, a young man who's already chairman of the Supreme Petroleum Council, a position above the oil minister Ali Al-Naimi. He's got an eye on future budgets, with plans for a mega fund worth $2 trillion. And while money from selling shares in Saudi's state-run oil company Aramco will go into that, the aim of the fund is to generate cash outside of oil. To that end, Saudi Arabia is also making a return to the international credit markets for the first time in a quarter of a century. So let's talk oil with our guest joining us from London this week. Spencer Welsh is at IHS, specialising in oil markets. Spencer, let's start with the failure of the Doha meeting. 12 hours of my life I won't get back. And there was a bit of surprise, I'll tell you, at the meeting, because a lot of us thought there would be a real push towards finding some consensus, realising that this was an opportunity for OPEC and non-OPEC members, and it didn't happen. Where did it go wrong?
Even if there had have been an agreement, it would have been very loosely worded, and so it wouldn't have really had that much value. But if we look back now at the signs before the meeting, it was fairly clear. So Saudi Arabia had openly said that they weren't going to take part in a freeze unless Iran took part. And Iran had quite openly said that they weren't going to take part in a freeze because they're trying to recover their market share following the removal of sanctions. So both those countries have made public statements, and so one of them would have had to have gone back on that, on those statements. So I guess there were a lot of signs that it was going to be very difficult to reach an agreement.
Okay, so basically, well, we always know the power that Saudi Arabia has, but basically two countries were, if not holding the talks to ransom, then at least it all rested upon them.
I think that's right. Though they have strategic differences, both countries are doing what they believe is best for their own interests. And yes, the crux of the meeting came down to whether some sort of compromise could be reached. And Iran didn't even go to the meeting.
So let's just stay with Saudi Arabia for a moment then, because you've got something else that seems to be going on there. We mentioned this already, the Deputy Crown Prince, Mohammed Bin Saleh, who is technically in a position that is above the oil minister, Ali al-Naimi. And he seems to be talking about taking Saudi Arabia away from the oil economy. Tell me your thoughts then, Spencer, then, I guess, on Saudi power in the oil market these days and how it might be changing, especially internally.
It's hard to read what's going on. Minister al-Naimi, I think he's 81. He's kind of been the oil spokesperson of Saudi Arabia for around 20 years. And so, potentially there is a bit of a transition that is starting. The Deputy Crown Prince, you're right, has done a couple of very public interviews in the last 6 months, talking about all sorts of subjects, not only oil. So it could well be that there is the start of a transition to a new oil spokesperson for Saudi Arabia.
Okay, so what can other countries do then, outside of the Saudi-Iran tussle, outside of OPEC even? Are there ways for them to start circumventing this logjam? Is it up to them to start striking deals independently between each other to sort of offset this huge influence that we see from the other players?
I think other countries reaching agreement to either freeze or cut would be, well, let's suppose they decide to freeze production, it would almost be meaningless. If they decide to cut, that would be very self-sacrificial, because obviously they will be cutting their own income, and because it's a smaller group, it would have a smaller influence on price. So it would be a very brave and maybe not necessarily an economically sensible thing to do. So therefore, our view at IHS is that it's very unlikely there's going to be any sort of deal for a good while yet. In fact, if Iran pursues its statement saying that it wants to recover its pre-sanctions production level, then we believe the market will naturally come back into supply and demand balance before Iran has reached that pre-sanctions production level. So it's less likely there's going to be any sort of freeze before the market naturally rebalances. Spencer
Welsh, pleasure talking to you on oil this week. Thank you for joining us.
Thank you. Nice to speak to you.
So we've talked a lot about Saudi Arabia and Iran and the obvious major players. What about a lesser-known petro-economy like Azerbaijan? Rory Challens visited the capital, Baku, and sent us this report.
By mid-June, this grandstand will be finished, and crowds will cheer Formula One cars as they shriek through Baku's streets. Powering the machines will be the substance that made Azerbaijan's capital a glittering boomtown: oil. But Baku's easy money, money that paid for reputation-boosting events like Formula One and the 2015 European Games, isn't flowing so easily anymore.
The first stage was in 2015. It was a shock for everyone. People unconnected to the oil industry, even someone selling herbs in the market. Even this person became interested in the London Stock Exchange. What was the price of oil on the London Stock Exchange? It was almost funny.
In 2013, oil and gas contributed about 3/4 of government revenue. Then, global prices tumbled. A budget deficit and credit rating downgrades soon followed. In 1999, as Azerbaijan's oil boom took off, the government started parking much of its spare billions in a wealth fund for the future public good. But recently, that fund has been having a rather torrid time. Last year, officials raided it to bolster dwindling foreign currency reserves and to prop up the sliding currency. It didn't work, and the local currency, the manat, has gone through 2 heavy devaluations. One consequence has been double-digit inflation, pushing up basic food prices. At the fund's gleaming Baku headquarters, its executive director explained why floating the manat was still a good idea.
To me, it was a very smart move. First of all, it helped the economy to adjust through the exchange rate. Second, it created extra competitiveness boost for the sectors of the economy. And it also showed that we have a good macroeconomic framework which reflects these changes.
But the economic shock is being felt by many ordinary Azerbaijanis. In January, protests broke out in several parts of the country. Such dissent is not tolerated here. Demonstrators and activists were arrested. The authoritarian government of President Aliyev is watching for any further signs of unrest.
And still ahead on Counting the Cost, we'll take you to Gwadar in Pakistan. Chances are you've never heard of it, but it's a key and controversial part of China's trading future. That story still to come. Right now, though, some tech news, and we're focusing on Google. For one, its parent company, Alphabet, just posted first quarter revenues of $20 billion, all driven by ad sales on mobile devices. But the way it makes money from the world of smartphones could be under threat, in Europe at least. Think about this. If you buy a smartphone which uses Google's Android operating system, then you get Google applications pre-installed, things like the Google Chrome browser. But is that anti-competitive? The EU seems to think so. In fact, it slapped Google with a charge alleging as such. Android represents 80% of the smartphone market globally, and if Google is found to be in breach of these EU rules, the company could face fines of up to 10% of its annual revenues. Here's what European Competition Commissioner Margaret Vestager had to say.
Based on our investigation, the Commission is concerned that Google's behavior has harmed consumers by stifling competition and restricting innovation also in the wider mobile space. Today's statement of objection finds that as a result of Google's behavior, rival search engines, mobile operating systems, and web browsers have not been able to compete on their merits.
For some analysis, I asked Georgios Petropolis from the European think tank Bruegel about Google's position in the market and how it almost seems to be penalized for growing into that dominant place.
Clearly, according to the European law, when you have dominant position, you have many restrictions over the market strategies that you can follow, because whatever you do, that will affect your competitors in a way that could raise suspicions for abuse of this dominant position. So in this term, this case can also help competition law and competition instruments to improve in order to face this challenge.
And from Brussels, we go to London to expand on this discussion about the mobile business. David Richards is the founder of WANDisco, that is Wide Area Network Distributed Computing. David, this case, the Google antitrust issue, kind of reinforced me how it really is just all about mobile now. You know, 20 years ago we were having a desktop browser battle, but now it's about mobile, because if you're not in mobile, you're not in the game.
Yeah, we're moving in a world really that involves mobile and cloud, and certainly those two technologies will define the technology industry over the next decade.
Define. Let's go into that a little bit more then. Are you envisaging a time then when you think we'll be completely off our desktops and everything will be mobile?
Yeah, well, I think the direction that the market's moving in today is moving away from companies having data in their own data centers, and they're moving to data that lives up in the cloud. And the way that we interact with the cloud tends to be more on mobile devices than it does PCs on desktops. And we saw recently Intel decide to reduce their staff by 10% because of a decline in their PC business. We saw IBM's results recently, where the growth engine for IBM was actually cloud computing, not their traditional storage business. So I think we're already beginning to see this transition happen.
But to be clear, we're not just talking about companies involved in the computing business, are we? I mean, it seems to me that, well, everyone kind of needs to be in the cloud, don't they? From consumers, for their own data. I'm particularly thinking about online retailing as well.
Well, I think data is the new oil, and where CIOs don't really know how much of this data they're going to have, it's really hard for them to build or to continue to build their own data centers. So they have to look for an alternative that's completely elastic, that scales to their needs, and really cloud computing is doing that. I mean, Amazon, for example, have a product called Amazon Web Services. Amazon Web Services is the fastest growing ever enterprise software business. It was the fastest ever to get to $10 billion. You know, most analysts believe that that's going to be a $15 billion business this year, and that's really replacing all those traditional storage technologies that we've seen previously.
Is it affordable though? You know, so far as being a company goes, I know as a consumer that if I need to pay for more storage on certain cloud services, then it's going to be fairly cost effective. But I'm wondering how expensive it is for a company, because if it is too pricey, that's going to shut a lot of smaller businesses out.
I was with a Fortune 100 CEO about 3 or 4 weeks ago, and I asked him how much does storage cost on premise versus in the cloud, and he said, you know, cost on site for us to do it is in the order of $20,000 to $25,000 per terabyte. Cost in the cloud is $3,000 to $5,000 per terabyte. So you see a 20 cents on the dollar cost reduction for all these actual costs for all these companies. So the cost reduction is significant.
Tell me about the risk factor though, and I'll give you a really simple consumer example here. Every time my computer asks me to back up my iPhone, I still back it up to the hard drive because I'm still worried that if there's a technical failure in the cloud, then, you know, that will be beyond my control. I won't be able to do anything about it.
Well, I'd go back 50 years, maybe 100 years, where people used to keep money under their mattresses, right? Because they'd like to feel it and touch it and know that it was there. And then we got these things called banks where people would send the money. Now, we don't really worry about whether or not money is going to get stolen from the bank. And the big cloud computing companies like Amazon Web Services, Microsoft Azure, Google Cloud, IBM Cloud are really good at managing and securing data, much better than any individual company will ever be. I mean, how many times a day do you think Amazon gets an attempted hack? Probably hundreds per second, but there hasn't been one singular instance of it. We see companies move to cloud for actually protection and security today. And there's already evidence of that. So you've seen the financial regulators, FINRA, in the US, the financial regulator in the US has already moved to cloud, and the FCA in the UK has announced it's moving to cloud. So I think the concerns about security and reliability are actually gone, and we're going to see lots of financial service companies over the next 12 months, over the next couple of years, move entirely to cloud.
Just a thought then, David, about some of those companies that might have missed the cloud boat. You know, you mentioned Intel, which is a perfect example of a company that concentrated on PC chips and didn't get into the mobile game and now is playing catch-up.
I'm seeing an increased number of those sort of what we might call legacy companies, companies successful maybe over the past 20 or 30 years, begin to evolve their business models. And Microsoft, I'm sure we'll see in their earnings, their growth engine will be cloud computing. IBM, the growth engine in IBM's results was in cloud computing. Those that make the change, I think, will prosper. Those that don't, well, I think they'll go the same way that DEC went when mainframes went out of fashion in the 1990s.
David Richards, very interesting to get your thoughts. Thank you so much for your time. Now, we've talked about the fabled Northwest Passage before, that is, the trade route through the Arctic Circle. But we haven't really mentioned China in the same breath, so let's do that now. This year, Arctic ice reached a record low for a second consecutive winter, which means a Northwest Passage allowing commercial traffic could be possible. It would link the Pacific Ocean on the left through to the Atlantic Ocean, and China thinks it could redefine global trade. Such a route would cut the distance between Eastern Asia and Europe by 4,000 kilometres. China's even published a shipping guide to the route as it tries to lower transportation costs for its trade-dependent economy. But it's not just China which would benefit from this shortcut, so there could be issues with sovereignty of the waters. You could sail, for example, coast to coast in the United States without going through the Panama Canal. The Northwest Passage has been crossed before. The first cargo ship sailed through it in 2013, but it is still untested as a reliable commercial shipping route. There's plenty of potential there for shipwrecks or even damage to the Arctic ecosystem. But ironically, it would be an increase in global warming, which would make the Northwest Passage a more viable and safe shipping route. So that means right now for China, it's about alternatives, new markets, new transit routes. For example, China's ploughing billions into a mega development project in Pakistan, which is expected to bring in about $2.5 trillion in trade over the next decade. Osama bin Javed has the details of this new China-Pakistan economic corridor, followed by The View from Beijing with Florence Louis.
Pakistan wants to turn this historic trade route to China and Central Asia into a gateway for economic revival. Gwadar is one of the world's earliest inhabited coastlines, some estimates dated from 3000 BC.
The sea pact is very important now.
$46 billion worth of investment by the Chinese government is paying for Pakistan's largest development project. The China-Pakistan Economic Corridor will connect the port of Gwadar in southern Pakistan to northwestern China via roads, railways and pipelines.
The improved environment in Pakistan has created favorable conditions for the China-Pakistan Economic Corridor. CPEC has become the main platform of all-round cooperation.
Close to 80% of China's oil imports are shipped through the Strait of Malacca. The voyage can take up to 3 months. The corridor through Gwadar will cut the 16,000-kilometre journey to less than 5,000. Cargo will travel through corridors in eastern, central or western Pakistan. Some Pakistani political leaders are accusing the government of ignoring smaller provinces. Security also remains a challenge. Gwadar has been plagued by separatist fighting. The infrastructure development promises to bring jobs, but many people in Balochistan are wary of losing out.
We are not against the project, it's a wrong perception against us. It's our soil and we also want peace and prosperity in this region, but we also want jobs and due share for the poor oppressed people of this area.
Government leaders have promised to listen to Baloch concerns and blame regional rivals for trying to sabotage development.
We are now capable and nobody can challenge us with an external threat. So then internal chaos is being encouraged by the hostile intelligence agencies.
I am a serving officer of the Indian Navy.
Pakistani military commanders say a spy sent to arm and finance separatists and foment activities against the state was recently captured. But unrest in Balochistan has continued for many years. Critics say state neglect has pushed some to take up arms against the Pakistani government. Now the state plans to spend billions of dollars to develop the impoverished region, and local people just want their fair share.
China's huge investment into Pakistan is part of its One Belt, One Road initiative launched in 2013. This mega project aims to connect China with dozens of countries in Asia and Europe via a vast network of roads and railways, oil and gas pipelines, even maritime routes linking ports and terminals. Now, the goal is, of course, to enhance economic cooperation as well as energy security. And one of the main reasons why China is doing this is because of slowing economic growth at home. Chinese companies need new markets to sell their products to. Chinese firms need new projects to invest their capital in. China estimates the One Belt, One Road project will add about $2.5 trillion in trade over the next decade. And then, of course, there's the geopolitical aspect. Political analysts say that China hopes that its investments into infrastructure projects abroad will help make foreign governments more inclined to cooperate with it, thus enhancing its diplomatic leverage abroad. It is economic diplomacy on a grand scale.
And that is our show for this week, but there's more for you online at aljazeera.com/CTC. That'll take you straight to our page with individual reports, links and entire episodes to catch up on. You can also get in touch with us by tweeting me at KamalAJE. Do use the hashtag AJCTC when you do, or just drop us an email. countingthecost@aljazeera.net is the address. That is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.